Hello there, this is Stefan Smith with StefanSmithFX.com. In this video report, I will be covering the Euro area and the European Union. According to a speech made by Mario Draghi, the president of the European Central Bank, it seems that the Euro area is suffering from an economic condition called stagflation. According to the statement at the 13th meeting of the International Monetary and Financial Committee, which occurred on October 10th, 2014 in Washington, D.C., Mario Draghi has stated that the Euro area is suffering from high unemployment rate, or a high unemployment rate, and a very low inflation rate. Those two scenarios combined at the same time equals stagflation, which can be a very troublesome economic condition to get yourself out of. Mario Draghi stated during his statement that the ECB is on alert and is prepared to take any monetary policy action, whether it be conventional or unconventional, in order to get the Euro area's inflation rate under but close to 2%. According to the Eurostat news releases regarding the inflation rate of the Euro area, it seems that the Euro area is experiencing an inflation rate of around 0.3%, an annual inflation rate of 0.3%, which is significantly lower than the 2% target rate that the ECB is trying to meet. Also, the unemployment rate for the Euro area, according to the Eurostat news releases, it is at 11.5% unemployment rate for the Euro area. So with inflation for the Euro area at 0.3%, when the target is to be as close to but under 2%, and with the unemployment rate for the Euro area being at 11.5%, it seems that the overall economic situation in the Euro area is not so good when compared to other countries like the United States, which is experiencing a more robust recovery when compared to the Euro area. So Mario Draghi once again said that he is prepared, he and the ECB is prepared to take any measures necessary or any steps necessary to make sure that price stability is at a level that they are comfortable with, which is an inflation rate of under 2%, but as close to 2% as possible. The mandate that the ECB has regarding the inflation rate is that it should be, the inflation rate, the annual inflation rate should be under but close to 2%. 2% or under but close to 2% is the mandate, and the Euro area is currently at 0.3%. Now, 0.3% is very, very close to deflation. And deflation is one of those economic situations that is absolutely hated by central banks. So there are a number of tools that the ECB could take advantage of in order to make sure the inflation rate doesn't drop below 0%, because if it's below 0%, then you have deflation. One strategy, though Mario Draghi never mentioned that he would actually take this measure in his statement, it's still considered a viable option by economists all around the world, is that the ECB could implement quantitative easing. Now, by implementing quantitative easing, the ECB is effectively buying securities, whatever securities that they deem necessary to purchase, and they're buying it with euros, with new euros. They're creating money and purchasing securities with that newly created money, essentially infusing the Euro area with additional euros. When more money is in circulation, you are easing policies, money becomes more available for the society, and it acts as a means to encourage borrowing and spending. So when you encourage borrowing and spending in an economy, it helps boost economic activity, and it also affects the inflation rate. It actually increases the level of inflation, which is what the ECB wants. So quantitative easing is a tool that many people seem to think the ECB will take. I also think that's a viable option. The Federal Reserve has already taken that option. In fact, as of now, they're still implementing quantitative easing. They're still purchasing securities. Well, maybe not now, but in recent history, they were purchasing securities with newly created dollars, essentially infusing the economy with new money. So the ECB could definitely take that route as well. Another option could be to simply cut interest rates even further. The interest rate that the ECB currently has is 0.05%. Yeah, 0.05%, which is a very low interest rate. But it seems that because inflation is where it's at for the euro area, it may make more sense to cut that interest rate to possibly zero or even negative interest rates. And that would also encourage spending and investment within the society. So those are two viable options. Be on the lookout for additional expansionary monetary policies from the ECB. Now, my overall view regarding the euro in terms of its valuation relative to other currencies is a very pessimistic outlook. I don't see the euro increasing in valuation relative to many other currencies, especially the United States dollar, because the Federal Reserve has a more of an opposite outlook for its economy. The ECB, the European Central Bank, sees more of they're seeing economic slowdown, they're seeing high unemployment rates, they're seeing low inflation. So it's encouraging them to implement a more expansionary monetary policy. It's encouraging them to implement a more expansionary, more accommodative monetary policy. Where with the Federal Reserve, because things are looking more, because the recovery in the United States is more robust relative to the euro area, the Federal Reserve seems to be headed toward a more contractionary monetary policy stance. They're talking about plans for normalizing monetary policy. So those are almost an inverse stance between the Federal Reserve on one hand and the European Central Bank. So be on the lookout for the euro to continue to devalue relative to the dollar and other currencies, and be on the lookout for the dollar potentially strengthening versus other currencies over the medium term. So that's definitely how I feel about the euro, the dollar, the ECB. So that's it. All right. So that concludes this report regarding the euro area. They are suffering from stagflation, which is, like I said, not a good thing to be suffering from. So definitely be on the lookout for the ECB implementing additional expansionary monetary policies. All right. I'm Stefan Smith with StefanSmithFX.com. I'll talk to you later.